once again. A lot has changed since the last quarter. While the world around us is still the same, we know that Indian equity markets have taken a turn for the better, posting very strong gains for the quarter. Last time when we met, and I distinctly remember it because the sentiment was downright pessimistic then, we had concluded with the optimism that, like always, investors' patience should be rewarded this time as well. And I think what has transpired since has helped reaffirm the faith in Indian equities. That said, there always are two sides to a coin, and the glass half full, glass half empty debate can be extended to the current market construct as well. The glass half full argument is that Indian equities have moved to new life highs. The quarter gone by was so strong that it probably marks a revival in fortunes of Indian equities on a sustainable basis. The glass half empty argument is that we still are just 3-4% higher than the high recorded 2 years ago on the Nifty. The Nifty small cap index is broadly where it was at the 2021 peak. And in that sense, perhaps, we continue to be in a large sideways consolidation and may stay there for a few while. Now, our two bits on this is, first, when we look at valuations, and we tend to look at valuations where we look at earnings yield versus bond yields. And on that, I think we are somewhat on the expensive side after the recent up move. If you go back in time, I think April, when the recent rally started in Indian equities, it was partly driven by the fact that global yields were already coming down, and partly driven by the fact that domestic yields had also started to come off after RBI went in for a surprise pause. So I think the ability for equity valuations to trade at higher levels when bond yields decline is something that we are trying to capture through this framework. But what's happened off late is that equity markets have continued to move higher, even as bond yields are not falling anymore. If anything, they've also started to inch higher. And this combination is making equity valuations expensive again. Now, secondly, coming to economy and earnings, I think we all know that India continues to be a very resilient economy, and it's probably one of the few bright spots in the world today. Locally, our profits to GDP have turned the corner after secularly declining between 2008 and 2020. In the last 3 years, they've been secularly moving higher. However, all of this said, the global picture is still far from clear. There are signs of monetary policy working its way through to support inflation at a lower level, but also constrict or sort of constrained economic growth to some extent in the global context. The global money supply growth stays very sluggish. And in that context, there are signs that the global economy will slow down. And while India is resilient, it's not immune to a global slowdown. And any global slowdown will have a bearing on India as well, albeit short-term in nature. So the long-term backdrop, I think it stays very constructive for India. However, in the context of not so cheap valuations and continued global fragilities, it may still be early to conclude that we've decisively moved out of the consolidation of the past 2 years. I think investors should therefore stay focused on asset allocation. Just as during market declines, we had advocated patience, we believe that investors shouldn't get carried away with these sharp rallies either. And similarly, on our portfolios too, we stay focused on bottom-up stock picking. We are always on the lookout for opportunities where there is a disconnect between near-term stock prices and long-term business prospects. And in that sense, market levels have little bearing on our portfolio construction. Even as we are always on the lookout for macro trends that may shape medium-term investment themes. Keeping the long-term picture in mind and not getting swayed away by near-term momentum is key to sustainable long-term wealth creation in our view. That's something that we have focused on in the past, that's something that we continue to focus, and hopefully that is something that will keep our portfolios in good stead. With that, I'll take your leave for now and look forward to connecting again next time. Thank you.